So it being 10 o'clock, I will call the Oklahoma City Post-Employment Benefits Trust meeting for February 14th to order. And our first item of business today is the approval of the minutes from the November 8th, 2021 Post-Employment Benefits Trust meeting. I would entertain a motion. I don't know. Why does she not have voting buttons? Well, I did that because I told her that's how you have to do it. Mm-hmm. Yeah, since at least one of us needs to, yeah, that's the wrong meeting anyway.
Oh, sure is.
Yeah.
Oh, but it says live meeting, that's why.
It's the only meeting she had up there.
No, that says 11/8/21.
That. Sorry, technical difficulties.
We'll just voice vote.
That's right. So I would entertain a motion to approve the minutes of the November 8th meeting.
So moved.
Second.
Moved by Diana, seconded by Neil. All in favor?
Aye.
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 Aye. Our next item, that hopefully I'll be able to see here, yeah, is a presentation of the investment performance review period ending December 31st, 2021. Doug Anderson, it's so good to see you.
So good to see everyone this morning. Good morning.
We arranged it specifically so you did not have to drive here in the snow and ice.
That's Thursday, is that right?
That's what I hear.
Well, very good. I'm glad to be here. If I could, I know that we have several reports here. Am I able to move this, or is that okay? So we have several monthly reports, and then we have the longer quarterly report. And if I could ask you to move to what I believe is the, let me see here. We have the flash report. Well, let's see, flash report for October, November, December.
Yes, actually, I think I misread the agenda. I think it's first is receive the monthly investment flash reports.
Okay.
For October, November, December, and January. So if you would like to proceed with presentation.
Okay, why don't we go to the January? Is that okay? I don't want to report or to repeat too many of these, so.
Sure.
Yes,
If you want
that
to
is the
switch,
page.
Press the button that says presentation, then you'll be able to see the presentation right there. Does that help?
So is this showing up on there?
It is.
It is. We're all seeing the same thing? Perfect. Well, we'll start with the bad news first, and that was January. You remember last year was a very strong year for equities, not so great for fixed income. And as a portfolio with a very long-term time frame, we have more in equities than we do in fixed income. But if we look through January, we had a couple of things hitting the markets at the same time. We have the inflation question. Inflation is upon us. We all are consumers around here, so we all know that inflation is trending higher. And that does present a bit of a problem, especially because it looks like the economy is in not the strongest state right now. Inflation is coming from a variety of things. At I'd say the middle of last quarter, October, November, that time period, it seemed to be more supply chain issues. Remember the ships that were off the coast of California and East Coast, et cetera. But now it's moving more to, I would say, energy prices. As you see dollar price of a barrel of oil above $90, that's definitely much higher than it was last year, twice as high, as a matter of fact. So the Federal Reserve, whose job is to make sure that the economy is running at full employment and at low inflation, is at a little bit of a crossroads right now. And that's causing some uncertainty, meaning they will need to raise interest rates to slow down the economy to reduce inflation. But when they do that, it has a negative impact on economic growth, right? It's really hard when you think about the price of money as interest rates, and as interest rates are very low, price of money is very low. Lots of folks are able to borrow and expand. And that's how our economy has grown. And some say it's a little bit over-reliant on cheap money, and I would say that's true. So the Federal Reserve is at a crossroads, which means our economy is at a little bit of a crossroads. And right now, the latest I saw was the market has a 65% probability that interest rates will be raised by the Federal Reserve 6 times this year. I think that's improbable. I think that it's probably going to see 2 interest rate hikes by the Federal Reserve, then they will pause and perhaps pivot. And if you see the underlying strength of the U.S. economy, it really feels kind of fragile right now. We're still getting over Omicron. We're still getting over COVID. We're still dealing with chip shortages and manufacturing in the United States. So it doesn't feel like a period of time where the economy is going gangbusters, and the Federal Reserve will have to come in and raise interest rates 6 times. So that is uncertainty that's weighing on the market right now. And then also, I think, of course, foreign issues are also a big deal. When you have 2 old, large powers that used to be joined at the hip, now potentially at odds, and I'm talking about Russia and Ukraine, I think that's creating some uncertainty in the markets. Is that as real as we are being told? I don't know. It seems like there are 2 sides to this story. One, that it's the closest that we've been to major outbreak of military conflict in Europe since the late 60s, but who's really to know? But again, I think the news, I think the financial press, I think they're more in tune with keeping things high profile in the news right now rather than maybe reporting what is actually going on in the world. But long story on the current market environment. If you will look on this slide here, you can see that the Russell 1000 was down 5%, the Russell 2000, which are small stocks, down 9%. International stocks to U.S. investors were down 3.7%, so that was a good time for us to be diversified. And then fixed income also negative, and that's because we have low interest rates and they're trending a little bit higher. If we look at the sector performance of the U.S. equity market, again, we have this one sector that is standing out from amongst all the others, and that's energy. Energy was unloved for 5 years, and now over the last 2 quarters, it's been the most attractive place to be invested. For the Russell 1000, for the month, the energy sector was up 18%. So that gives you an idea where oil prices are and where the market is trending. If you look at fixed income performance down below, that is unusual. You usually don't see fixed income or bond prices going lower when equity prices are doing the same thing, but the inflation scare that's driving some of the volatility is behind that. Could we go to the next slide, please? This is a long-term picture of the total fund. If we look at it, we started all the way back in 2009 with $6 million. Contributions have been substantial, $152 million over that time. The withdrawals have been $105 million. So the trust is doing what it should be. It's paying out benefits. The gain in the portfolio over this time has been $46 million, which left a market value of $98 at the end of January. And our return over that period of time, total return is 176%, which tells us that over that period of time, income at $9.5 million. So again, we have had income as a percentage of the beginning market value, 158%. So the combination of income and capital gains have driven portfolio higher. And the next slide, please, is the total fund rate of return. So you see on the upper left-hand side there, market value of $98.6 million. That was a decline of 4.37% during the month. So we did see a negative return. And I think it's also important to take a look at longer-term figures here. So on the 1-year 12.59%. For the last 3 years, 14.02%, and that's an annualized rate of return net of fees. And then over the last 5 years, 11.5%. If we think about this, to drive a 3-year return of 14.02% with a portfolio that's not 100% equities, this has been an extremely strong period for equity investors. And remembering that we've gone through the COVID crisis over this period of time is pretty important. As I go down the list here, we start with fixed income. Again, negative results here. Negative results across the board. Again, low interest rates are moving higher. It's really difficult to get away from that in the bond market, given that bonds' primary driver of performance is interest rates, whether they're going up or going down. So that's been a net negative for the month. If we look for the domestic equity composite, it's also been negative. We do have our poorest performer was the small cap growth, and that's across the board. Small cap growth companies have been doing poor throughout the market. If you look at our S&P 500, it's tracked directly of what it should. Our mid-cap index fund down 7.86, which is exactly what the index did. And then our Hotchkiss & Wiley, this portfolio that I know was testing our patience for some time. They're investing in mid-sized companies, very value-rich companies, and they actually had a gain during the month, which is remarkable. This is a portfolio that does display volatility at times. And if we look over the last 1 year period of time, you can see our index fund did track the benchmark where it should. The domestic equity composite was up 18%. The mid-cap index, it tracked what it should, but then the Hotchkiss & Wiley, this mid-cap value portfolio, is up 39%, double what the S&P 500 did in rough terms. Then the small-cap growth portfolio was down 4.16. One sector was responsible for most of this, and it's energy. Hotchkiss & Wiley has invested rather heavily in energy for some time because it has been so discarded by the rest of the market. They haven't changed anything in the portfolio over the last year. Not much. They've made a few trades, but for the most part, they're long-term investors. And then going down for our international equity exposure, which is 10.5% of the portfolio. Again, same sort of picture there. Value equity, the index is down 4.8%. This portfolio is up 2.24%. So we do have some bright spots, I guess you would say, in the portfolio. Causeway is doing well, up 14.5 versus 7.5 for the benchmark. And again, this is all as of January 31. Show expense ratios on the right-hand side here. But again, market volatility. What we expect to happen is usually not what does happen. I would have expected that if the equity market traded off like it was, that our portfolio, such as Hoisington, which is the risk mitigator, would have done better, but that's not the case as interest rates have crept higher while the market has gone lower. I'm having a call with our fixed income analyst and the folks at Hoisington later this afternoon. I don't expect to learn too much different. They're very patient, very long-term oriented. So 1 month of performance I don't think will change their view of the world, which I think we should be positive about that. But as far as the 1 month return, when the 3-year return annualized for the S&P 500 is 20.7, we should probably have a reasonable expectation that there's going to be some volatility. Volatility meaning maybe some negative returns out there. So with that, that's the January 31 update. I'm happy to take questions, as always.
Does anyone have any questions for Doug? Hearing none. And I'm assuming that we are not having a presentation then on the remaining flash reports. Those are in your packet. So I will entertain a motion to receive the monthly flash reports.
So moved.
Second?
Neil moves. Amy seconds. Diana, did you second? Amy, sorry, masks, yeah. All in favor?
Aye.
Aye.
Any opposed? Motion carries. Yeah. Darn Okay, the next item on our agenda is the presentation of the investment performance review period ending December 31st, 2021. Are we going to have a presentation of that?
Perfect, thank you.
Okay.
I will take a few minutes on this, just to take a victory lap, if we will, for last year. It was a good year. If you could please turn to page 1. A quick update on our firm. $120 billion in assets that we advise for our clients. 87 employees. We are based in Florida, Winter Park, Florida, and we continue to grow, not only externally, but also internally. And at the following page is an organizational chart showing this firm is not just me by any means whatsoever. You'll see that our consulting division is in the middle center there, the middle at the top. This is growing, as you may know. I am one of several consultants there. Last year we did add one person, oddly, Oleg Sidyak on the upper right-hand side of that center section. He's a CFA, an FSA, and an EA, which are actuarial terms, and a chartered financial analyst. And he does asset liability work. That is his job. He is as credentialed as anyone. And once you talk to him for a few minutes, you can get used to the Ukrainian accent. Incredibly bright fellow. You look on the research side, again, these are the folks who don't go out and consult to clients like I do. Their job is to stay in the office or to go out and visit management and to help our clients build the portfolios that they need to. That is an incredibly smart group of folks that I enjoy working with. Client solutions, you may not be aware, but those are the folks who produce the reports, the flash reports, this report, et cetera. It is a significant task, and these are I think, under-recognized group of professionals that are also important to the service and the product that we provide our clients. You will see operations, which is a group. In today's day and age, you have to have a significant group of operations, and I will say that now, more than 5 years on, after our firm merged with A&Co, I am glad to have other folks doing those jobs other than me. Lets me do what I like to do, which is this. So any questions about our organization? Continue to grow, continue to be strong, moving forward to provide the services our clients need. Thank you. So we're going to go right through the market environment. Last year was a great year for equities. It was a year that saw some leadership changes from growth to value, large cap to mid cap to small cap, because our economy was in transition last year. If I could get you to turn to page 14 of this report, unless anybody really wants to go through the market environment in depth, I'll take that as a no. Here's the big figure that I like to refer to, 17.1% total fund rate of return for last year. That is fantastic. We need to be reasonable, and our expectations need to be reasonable. We've had 3 fantastic years in a row. Normally, the U.S. equity market has shown a propensity to be down 1 out of every 4 years, so this might be that year. We look at the world in a very long-term orientation. We smooth returns over time, which is good. Even if we had a negative return this year, the last 3 years or last 2 years would probably be a positive return over that 3-year observation period. But again, I think that this shows us that we're diversified, that we're taking appropriate amount of risk for the portfolio, and that our overall portfolio design is suitable. I think on page 15, a few things here. This is the history page, and really I don't want to go too much in depth on this except for the last few parts here, where we have the Vanguard S&P 500 index fund. We replaced it last year. Not because it wasn't a great fund, not because it was underperforming, but we found the same thing for lower cost, and we replaced it with the Fidelity S&P 500 index fund. Also, July of last year, we changed share classes, which meant same portfolio, just a different share class, and we did that on 3 of the funds to reduce costs. So again, we're getting the same product at a lower cost on 4 of our funds last year, and continue to think that we have we're not sacrificing quality for any of the managers that we have. On the next slide on page 16, unfortunately, if you remember to the January 31 report, we were below $100 million. But you can see that we ended the year at $103 million, which is, to me, a threshold that is worthy of recognition. We started with $6 million here not too long ago, and now we're over $100 million through mostly contributions, but also the investment gains in the portfolio has done a nice job here. Page 17 shows us, again, this is a history lesson. Remember when we started investing here, it was just out of the teeth of the financial crisis. So what this chart shows us is that we carried more fixed income and less equities in the early years of the portfolio. And I think that that was prudent at the time, given that we did not know whether the economy was going to recover the way it did or has since then. The next couple of slides are asset allocation. Notice on this slide that the chart on the left-hand side and the chart on the right-hand side are fairly, yeah, it's perfect, are very similar to one another. In fact, the percentages, the biggest percentage change is a small one. Domestic equity went from 62.9% to 63.9%, and this is during the fourth quarter, and that's because returns were so strong. And the same is true on page 19, where the names don't change, the order doesn't change. It's very similar one quarter to the next. And remember, it's because we're very disciplined about how we allocate the portfolio. You'll see here that, again, very modest changes in the percentages, if any, across this. And then on page 20, this is for the fourth quarter of last year. You can see that we started the quarter with a $96.3 million. There was a contribution of $1 million during that quarter, and what we did with that was we allocated it to fixed income, right? That was probably a tough thing to do at the time, right? Equities are going up. Why are we giving money to the laggard, which is fixed income? But that's because we're disciplined, and it did help a little bit during January. But our job is not to go out and forecast what the market's about to do. It's to build a plan, execute the plan, and change the plan only when we need to. And that would be more of a change in the benefit structure rather than markets, unless something incredibly traumatic would happen. So that is the cash flows. Now on the next slide, on page 21, this goes back, this is the total fund rate of return. For the quarter was 6.04, for the year to date 17.1, for the 3 years 18.37, for the 5 years 12.91, and for the 7 years 9.90. The policy index is a passively managed portfolio allocated to the investment policy guidelines. That is an extraordinarily difficult benchmark to beat. When we look on the right-hand side of the total fund composite net of fees row there, which shows us the returns, you have the percentage, and then you have a number in parentheses. That number in parentheses is your percentile rank versus similar funds. What that tells us that in the quarter, 6.04 ranked in the second percentile of public funds. That means that you beat 97% of other funds out there. When we look back over the last 1 year, your 17.07% rate of return ranked in the fourth percentile. That means you outperform 95% of other funds out there like you. And then over the last 3 and 5 years, you can see you're ranked in the first percentile. Again, you were in the top percentile of public funds out there over those periods of time. Yes, we should be very proud of this. This is not something that happened overnight. We've done many, many things to this portfolio over time. I would say that we have gravitated to more and more equity in the portfolio because I think in the early days, we were more concerned with return of capital rather than return on capital. And I think that slow start really helped us get comfortable with the allocation, and it helped us be comfortable with the fact we are going to have some volatility from time to time. Even over the last 7 years, we ranked in the fifth percentile.
So Diana points out that we were nervous in the beginning. And as
Absolutely.
someone who's been associated with the OPEB Trust since the beginning and through the whole thing, I will say that it's gratifying to see that the discipline does pay off.
Absolutely. Well, I think we were worried about
losing our principal, yeah.
If we had $6 million, if we lost half of that, this very trust would have been in jeopardy, right? Severe financial jeopardy. So I think that sometimes starting slow is the right way to do it. It's almost like the opposite of if you're investing for a 401k, hypothetical terms, you're very young, you need to be as risky as possible because you can sustain losses when you're young because you have a lot of time to make that up. I think in this case, it was slightly different than that we didn't have the ability to sustain significant losses because we had benefits to pay and it was a new program and you really don't want to start out with a significant shortfall. So thank you for staying with us through that entire program. That was difficult at times, but as you see, the results have been quite good. The total fixed income portfolio, this is an area that I think that is underappreciated again. Over the last year, slight loss, but that ranked in the 10th percentile. The last 3 years, 7.09, which outperformed the benchmark, which was up less than 5%. And over the last 5 years, 5.29. If we look down to the total domestic equity over the last year, we were top third almost, just a little bit outside of that. But if you look down the list, our index fund did exactly what it should have. The mid-cap index was up 24.5%, then Hotchkiss & Wiley with that first percentile rank. I just want to make sure that Hotchkiss & Wiley is not always in the top percentile. In fact, they spend a lot of times below percentile. A very difficult period of time for them was the last 5 years, if you take this last year off of it, because they were buying underappreciated stocks when the world wanted to own Apple and Amazon and Microsoft, and that was really not what they buy. And then the following two managers on the next slide are 14.3% for Stevens for the last year, which has fallen off pretty dramatically, and then the Causeway up 9.07. Again, Causeway is a value equity manager, so we will see some volatility there. I hope there aren't too many questions about this. I feel like I've been taking a lot of time this morning, but I do want to say discipline, good risk aversion, which I think we have to recognize that there might be some more risk in the portfolio and in the markets right now than there were last year, but probably would have said that about the previous year and the year before that as well. I would like to go a few more slides here. If we could go all the way to page 46 of this report. Again, as fiduciaries, we have certain things that we like to look at every quarter to help remind us of where we are. So page 46 is the status summary. This tells us how we feel about our managers based on primarily quantitative but sometimes qualitative factors. We have one manager who is not at the highest rating, and that is Hotchkiss & Wiley Mid-Cap Value. We placed them on our watch list or on alert in 2019. I would like to upgrade them to in compliance given the fact that they're the top performing mid-cap manager out there right now. No other changes there. None of the managers have any significant ownership or organizational changes. I would like to go to page 47 next. This shows the expense ratios of the funds versus their peer universe or their category average, as it's stated here, and then the difference. As we go through all of these, we have a weighted average at the very bottom, so this is weighted by the amount allocated to each of them. Expense ratio is 44 basis points. The category average in the same weighting scheme is 90 basis points, so we're better than half off of the average out there, which saves the trust $430,000 per year. And again, no sacrifice of quality to get that. And then I think on page 51 is the last slide I would like to go to. This is our asset allocation matrix. This is the table that shows us how we're allocated versus the investment policy statement. If we look here, core fixed income at where it is today at 15.9% versus 18% for the target, so we're a little bit under there. If we look at our high yield fixed income, our active duration fixed income, those are also slightly below. And domestic equity is a little bit high. I would say if there's any cash flows coming into or coming out of the trust, we'll use it to either give money to fixed income or take money away from equities to get us back closer to our target. And with that, I'm open to questions.
I notice our cash is outside of policy. Can you just give us a quick description of that?
Yeah, we carry a zero cash target allocation here, so there's no.
So anything is,
Yeah.
okay,
And remember, there's also a cash buffer outside of this,
yeah,
which is not shown on here. So anytime there's any cash whatsoever, $127,000, it could be $1,
yeah.
and it would show out of, but thank you
Okay.
for bringing that up.
Doug, I do have a question. Hotchkiss and Wiley, you're recommending that we take them off of the on alert. How long have they been in compliance for us to remove them from that?
How long have they been in compliance? I'm sorry.
For us to remove them from that on alert list? I know you're recommending we take them off that.
Sure. So I'm looking at the 1-year number. And that's the one that's really driven. It's been a long time. I don't like to keep managers on the watch list any longer than necessary. And if I go all the way back to, I show them, oh, that's not it. That's the December 31. I'm sorry, for the year to date, you see that they were up 39%, which is in the first percentile. If you would like to keep them on watch list until, say, the 3-year number moves back above the benchmark, I can understand that.
I know it'll be at the pleasure of the rest of the trustees, but that would be my preference since
Okay.
we're just looking at a 1-year number.
Understood. We'll keep them on watch, but looking to upgrade. How about that?
Absolutely.
And again, this is a signal for all of us together, so input is very welcome on this.
Any other comments, questions for Doug? Okay, so that item is complete. I don't think we need a motion on that. So our next item is an acceptance of the interim financial report for the 6 months ended December 31st, 2021. Rhonda?
If you would like, I can present the audited financials for June 30th first, and then move to the December. It's up to you.
Sure, that's fine with me.
Okay.
The pleasure of the trust. Are we good with that? Okay.
Those begin on, right after the December. I don't know what page it is in your packet, but yeah, you've got it up there. So it is the audited financial for the trust. We did get an unmodified opinion, which is what we always want. And the full report can be found starting on page 1 of the unmodified opinion. On page 7, the statement of plan of net position. At June 30th, the trust reported a net position of $97.47 million. I'll wait till you get there. This is an increase of $25.4 million over the same period when the net position was $72.08 million. So it was the prior June 30th number. And it's primarily attributed to the net investment income of $22.36 million, contributions of $26.1 million, and offset by the benefits paid of $23.09 million. One thing I would like to point out, the next thing I'd like to point out is on page 35 of the annual report, and it's the funded ratio. Okay. The trust funded ratio looks at how much actuarial liability the trust has versus how much net position or money it has to pay the liability. At June 30th, COTPA could pay 48.1% of the liability with the funds it had, whereas the city could pay 18.7% of the liability. The trust funded ratios have increased for both the city and COTPA, and if you turn to page 37, You can see since 2017, for the city, it has increased from 8.5% funded to where we are now at 18.7%. And then on the next page, 38, COTBA started in 2017 at 19.8% and is now at 48.1%. And that concludes my report for June 30th. If you have any questions, I'd be happy to answer them.
Any questions from the trustees? Okay, let's move on to the December 31st.
All right.
Oh, I'm sorry. I would entertain a motion to accept the interim financial report. I'm sorry, can you go back to the previous, so I know what I'm reading? Entertain a motion to accept the interim financial report for for the fiscal year ended June 30, 2021. No, we just received this one.
So moved.
June 3rd, yeah.
This is the one we received just now. She hasn't done that one yet. We went out of order, yes.
So moved.
Second.
All in favor?
Aye.
Aye. Any opposed? Motion carries. Okay, so the next item on our agenda.
Is the
Actually,
interim.
the previous item on our agenda is the
Yeah.
acceptance of the interim financial report for December 31st. Sorry, we
Okay.
just had a little confusion about which report you were reading from.
Yeah. All right, now, the only thing I'm going to talk about on this one is the plan of net position. So the changes in the plan of net position, that's on page 6 of the interim report. So at December 31st, our net position was $104.8 million. This was an increase over June 30th. That's why I wanted to present the June 30th first. It was an increase of $7.3 million when the net position was the $97.5 million, and is primarily attributed to $5.89 million in net investment income, contributions of $13.12 million, then offset by benefits paid of $11.64 million. And that is all I was going to report on the December interim. If you
Okay,
have
are
any
there any
questions.
questions from trustees for the December report? I think fortunately Doug has braced us for the coming months when we see that the numbers aren't quite that good. But thank
Yes.
you, Rhonda, for that report. So I would entertain a motion to accept interim financial report for the 6 months ended December 31st, 2021.
So moved.
Thank you, Neil.
Second.
Amy? All in favor?
Aye.
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 Any opposed? Hearing none, motion passes. Okay, the next item on our agenda is to ratify claims. I would entertain a motion to ratify the claims.
So moved.
Second.
All in favor?
Aye.
Any opposed? Motion carries. Any items from trustees? Hearing none. Staff? Any other interested parties? And hearing no other comments, we are adjourned.